The Brookmont Catastrophic Bond ETF, which trades on NYSE ARCA under the ticker symbol ILS, aims to minimize the impact of a natural disaster for investors while also providing daily trading flexibility. Joining me now is Ethan Powell, Principal and CIO at Brookmont Capital Management. Ethan, welcome.
Ashley, thanks for having me.
So before we dive into the stats, what are cat bonds and why are they important?
Well, other than having a terrible asset class name of catastrophic bonds, they're actually a super fascinating alternative income asset class. We're talking low double-digit floating rate yields. And most importantly, the risk you're assuming has nothing to do with credit risk and everything to do with large-scale catastrophic events. So you can imagine the diversification benefits of an asset class like that to an otherwise diversified portfolio is tremendous.
All right, we understand that 2025 was a record year for cat bonds with more than $25 billion in new issuance and over $60 billion outstanding. What drove that demand? Well,
I think your viewers are probably familiar with what's called the insurance gap, right? Which it's about $250 billion globally of damages that aren't insured. And what we see increasingly is that insurers are leaving specific geographies or writing out perils from their insurance agreements, leaving people, particularly in high peril areas, underinsured or self-insured. And so what we see is even states have become very large issuers of these catastrophic bonds. You've got Florida issuing hurricane bonds, Texas issuing wind and flood, California issuing fire. And what's really driving it is that insurance gap and this, being capital markets, we're traded on an exchange. Price discovery is everything in some of these opaque markets, and then bringing additional scale to the marketplace to help solve some of the property and casualty affordability issues. That's what this asset class is all about. That's what's driving its interest, and that's what's driving additional scale.
Is climate change having an impact on the cat bond market?
Yeah, it's really interesting. We like to talk about climate volatility because we don't want to get caught in the whole political element of climate change. But if you look at last year, we had no hurricanes making landfall in the United States. And yet we still have $100 billion of insured damages, mostly through secondary perils like the LA wildfires were about $40 billion. And then you had severe convective storms, which are, you can think tornadoes and wind and flooding and hail creating damages, but not in the same sort of concentrated manner that a hurricane hitting a highly populated city in Florida might.
All right, and I just want to go to the screen for a minute. We are seeing our bell ringers ring the first trade bell. And we're going to go back into the interview. Apologies. So what separates cat bonds from yields?
They're a floating rate instrument, right? So they are typically tied to SOFR, and that's the base rate, and it's actually updated to every quarter to the prevailing risk-free rate, right? So unlike a traditional fixed income instrument that might have a 10, 20, 30-year time horizon, creating a lot of duration risk, here it's floating rate. So you don't really have to worry about whether or not the Fed's going to cut, raise, or do nothing.
All right, and we're only a few months from the start of hurricane season. How are you and your team updating the ETF's holdings to best benefit investors?
We really think this asset class is a strategic long-term asset class, and it's best invested in through diversification. So we're going to continue to stick to our guns and try to keep position sizes below 2%. And then we're also positioning the portfolio to sort of mimic the broader cat bond market. And what we mean by that is if there's 20% in Florida hurricane bonds in the marketplace, we'd like for our ETF to reflect 20%, but really the best of the best as far as security selection is concerned within that portfolio composition, right? So again, diversification is the name of the game. It's not quite the wild ride that people think it is. This isn't a a sort of binary bet on weather outcomes necessarily. For example, 40 billion of LA wildfires, but there was only 250 million of cat bonds that were impacted by that. So despite the name, it really does take a large scale catastrophic event to start to impair these because they're really designed to protect against tail risk.
All right. Thank you, Ethan Powell, Principal and CIO of Brookmont Capital Management.
Thank you.